Imagine you have finally done everything right. You have automated your savings, paid off the high-interest debt, built an emergency fund that could cover 6 months of expenses, and reached a point where your basic financial needs are met without constant anxiety. You sit down on a Sunday afternoon, review your accounts, and feel something unexpected. Not relief, not pride, boredom. The numbers are moving in the right direction, slowly and predictably, and there is no crisis to solve, no fire to put out, no urgent decision demanding your attention. That feeling, that quiet calm, is exactly what most financial advice promises to deliver. But here is the problem that no one warns you about. Comfort has a trap door underneath it, and the trap is not that you will spend too much or save too little. The trap is that you will stop optimizing entirely. You will accept good enough as final enough. And over a decade or two, that quiet acceptance will cost you more than any financial mistake you ever made in your anxious years. The comfort trap is a behavioral pattern documented in longitudinal studies of household finance, though you rarely hear it discussed in personal finance content because it does not sell courses or generate clicks. Researchers following the same households over 20 years found a consistent curve. Financial anxiety decreases rapidly as households move from instability to basic security. But financial optimization, meaning the ongoing effort to improve systems, reduce fees, increase returns, and capture small efficiencies, also decreases after a certain point. The very same relief that makes life livable also kills the discipline that creates wealth. Households that never escape scarcity make terrible decisions out of fear. But households that settle into comfort make no decisions at all, and over long time horizons, no decisions is almost as expensive as bad decisions. Let us look at the math of what happens inside the comfort trap. Consider two households, both earning identical incomes and both saving 10% per month. Household A remains slightly anxious, not panicked, but aware. And as a result, they review their investment allocations once per quarter. Negotiate their cable bill every year, switch credit cards when better rewards appear, and refinance their mortgage when rates drop by 0.5%. Household B feels comfortable and safe, so they set up automatic transfers and never look again. Their investment allocation drifts over time. Their cable bill slowly increases. Their credit card rewards become outdated. Their mortgage rate sits 2% above the market rate for years. After 20 years, the cumulative difference between these two approaches, just from the small optimizations that Household A performs and Household B avoids, is approximately 25% of total wealth. Household B does everything right in the big picture. They save consistently. They avoid debt. They live within their means. And they still end up with substantially less because comfort made them stop paying attention. The psychology behind this trap is what behavioral economists call adaptation or hedonic habituation. Your brain calibrates to whatever your current reality is, and once something becomes normal, it stops generating motivational signals. The stress of financial insecurity is unpleasant, so your brain works hard to escape it. But the calm of financial security is pleasant, so your brain has no reason to push beyond it. This is why you see so many people who are perfectly capable of earning more, saving more, or investing better simply choose not to. It is not laziness. It is not lack of intelligence. It is the absence of a psychological engine that only runs on dissatisfaction. The trap is that dissatisfaction feels bad while you are in it, but it is also the only reliable driver of continuous improvement. Remove it too completely and the engine stops. Now zoom out to the systemic level, because this pattern is not just individual. Entire industries are built on the comfort trap. Subscription services, automatic renewals, loyalty programs that reward inertia, and financial products with complex fee structures all depend on customers who are comfortable enough not to shop around. The banking industry knows that customers who have been with the same bank for more than 5 years are dramatically less likely to switch even when fees increase or rates drop. The investment industry knows that the average investor checks their allocation less than once per year after the first 3 years of account opening. The insurance industry knows that renewal rates approach 90% after the first policy term, regardless of price changes. Comfort is not just a personal feeling. It is a commercial asset that companies extract value from, and they have designed their systems specifically to keep you in a state of satisfied inattention. Historically, This same pattern appears in economic bubbles and crashes. During the long expansion periods of the 1990s and 2000s, households that had achieved comfort stopped rebalancing their portfolios, stopped questioning real estate valuations, stopped maintaining emergency cash buffers. The comfort of rising markets made active management feel unnecessary. Then when the downturn came, those same households were overexposed to risk, underhedged against loss, and forced to sell at precisely the worst time. The investors who fared best were not the ones who predicted the crash. They were the ones who never stopped the small, uncomfortable habits of periodic review and rebalancing even when everything felt fine. Comfort made them stop. Discipline, which is not the same as anxiety, kept others safe. The solution to the comfort trap is not to manufacture anxiety or to live in a state of perpetual dissatisfaction. That would be exhausting and counterproductive. The solution is to separate the feeling of comfort from the behavior of review. You can feel perfectly comfortable about your financial life while still scheduling a quarterly 30-minute session to check fees. Compare rates, rebalance allocations, and ask one simple question: is there a small improvement available that requires almost no effort but compounds over time? This is not about grinding or hustling or optimizing every dollar. It is about recognizing that comfort is an emotional state, not a final destination, and that the systems which got you to comfort are not the same systems that will keep you there for 30 years. You will know you are in the comfort trap when you cannot remember the last time you looked at your investment expense ratios, when you automatically click renew without checking competitor pricing, when you assume your bank is giving you a competitive interest rate because they have been fine so far, or when you realize that your financial routine has not changed in several years, even though your income, your family size, and the economic environment have all changed substantially. Those are not signs of failure. They are signs of normal human adaptation, but they are also signs that the trapdoor is open beneath you. The mathematical reality is that small inefficiencies compound like small efficiencies. A 0.5% higher expense ratio on your investments over 30 years costs you approximately 15% of your final balance. An extra 1% on your mortgage for 10 years before you refinance costs you tens of thousands of dollars. A credit card reward structure that pays 1% instead of 2% on your annual spending costs you hundreds of dollars every single year without you ever noticing. These are not catastrophic numbers in any single year. That is exactly why comfort ignores them. But over a full financial lifetime, the difference between someone who makes small annual optimizations and someone who settles into comfort is not small at all. It is the difference between retiring at 62 and retiring at 68, or between a comfortable retirement and a constrained one. So here is the practical takeaway that does not require you to become anxious again. Set a recurring calendar event for the first Sunday of every quarter. That is 4 times per year. During that 30-minute session, you will check 3 things. First, your investment expense ratios and allocations. Second, your recurring bills for any automatic increases. Third, the interest rates on your savings, mortgage, and any debt. That is it. 30 minutes. 4 times per year. You do not need to make changes every time. You just need to look. The comfort trap closes when you stop looking. Keeping your eyes open, calmly and without anxiety, is the only thing that stands between you and a slow, invisible, compounding loss that you will never feel in any single month, but will absolutely feel in the final tally. Comfort is not your enemy. Inattention is. And inattention is just comfort that forgot to set a calendar reminder.